They told you weekends were safe. They told you nothing important ever happens on a Saturday. And yet, yesterday, in a dead market, silver detonated 10% vertically to $79.25. It is now Sunday morning. Tokyo opens in a few hours, Shanghai after that. And behind closed doors, in windowless rooms you will never see, bullion banks, clearinghouses, and central bank officials are in emergency risk meetings on a day they were supposed to be at brunch. That's your first signal the script is broken. Because when the people who write the rules interrupt their weekend, it's not to protect you. It's to protect themselves from the mathematical blast radius they just triggered. So let's be very clear. The spot price flashing on your phone right now is not the market. It is a stressed out scoreboard in a rigged stadium, glitching under load. The real market is in atoms, not pixels. In bars, coins, and industrial stockpiles. And that market just sent a message. I'm done pretending. What actually happened yesterday? On the surface, it looks simple. A 10% vertical candle to $79.25. But under the surface, in the plumbing, something much uglier occurred. Picture the global silver system as a hydraulic circuit. For years, the bullion banks have been pushing on one side of the system with paper promises, futures, swaps, unallocated accounts, while a thin trickle of physical metal leaks out to industry and to people like you. As long as flows are slow and predictable, the system behaves. Pressure builds, but the valves hold. Yesterday, that changed. Yesterday was hydraulic lock. In an engine, hydraulic lock is what happens when incompressible fluid floods a cylinder that was designed for air. The piston moves up, the liquid refuses to compress, and something has to give. Either the engine stops or the metal breaks. And that's exactly where the silver system is this weekend. For years, they have been compressing risk into a paper cylinder, assuming liquidity would always be there when they needed to roll, to hedge, or manage the price. Yesterday, for a few beautiful and terrifying minutes, the market reminded them, silver is not air. When price teleported 10% higher into 79, it did not just hurt a few speculators. It ripped through the balance sheets of bullion banks who are structurally short. It pushed margin models at the clearinghouses outside their normal range. And it took a sledgehammer to the comforting illusion that we can always smooth this on Monday. Here's the invisible catastrophe no one on CNBC will spell out for you. When silver moves like that on a Saturday, the banks do not just lose on yesterday's price. Their entire book of paper promises has to be remarked. Every unallocated ounce they owe, every industrial supply contract they've quietly underwritten, every "we'll get it for you at spot plus 50 cents" agreement suddenly has to be measured against a market that just reminded them spot was a lie. The atoms are in charge now. In the risk rooms this weekend, they are not talking about volatility. They are talking about containment. If silver opens in Asia above 80, every model they trust starts spitting out numbers with too many zeros. Value at risk goes from annoying to career-ending. Cross-margin calls start to cascade across desks that were already stretched on rates, FX, and equities. And the clearinghouses, the supposedly boring utilities of this system, have one nightmare question on the table. If one of our biggest members cannot post margin on Monday, do we eat it or do we shut the market? This is why central bankers are on those calls today. Not because they care about silver. They do not. They care about collateral. Silver is wired into the system in ways the public never sees. As a hedge, as inventory, as a component of structured products that were designed by people who assumed a comfortable $50 ceiling forever. When the underlying asset starts behaving like a grenade instead of a brick, the whole structure above it starts to wobble. And here is where the physics becomes unforgiving. Unlike software, you cannot patch a supply chain overnight. Unlike interest rates, you cannot jawbone atoms into existence with a press conference. Silver in solar panels is welded into glass for 30 years. Silver in high-end electronics has been vaporized into microscopic traces you will never recover. Silver in defense and aerospace is bolted into systems that are now considered mission critical. Every time the price goes higher, the herd thinks demand will fall. In reality, we are in an inelastic zone. For the sectors that matter, higher prices do not reduce demand. They increase the urgency to secure supply. That is a self-reinforcing loop. And yesterday's move was the system tapping the glass. Warning, the loop is now running. Inside one of those Sunday war rooms, the conversation sounds roughly like this. Can we push the price back under 75 before Tokyo? What if Shanghai cash markets simply ignore us and trade at 85? What do we do if large industrials start front-loading next quarter's purchases right now? Because remember, the bullion banks do not just face price risk, they face delivery risk. If too many people, all at once, say, "I do not want your paper anymore, I want the atoms," the game changes from managing a chart to managing a shortage. Think of the silver system as a dam. Behind it, decades of suppressed price, delayed investment, and industrial demand that was never properly hedged. In front of it, you, the prepared investor, standing in the dry riverbed, being told by every talking head that there is no water problem. Yesterday's 10% vertical move was not the flood. It was the first crack you can see from the valley. Water is starting to spray through the concrete. The engineers, the risk managers, are on the wall right now, on a Sunday, plugging holes with their bare hands, arguing about whether they can hold another week, another month, another quarter. But here's the problem with cracks and dams. The pressure behind them is not negotiable. Geopolitically, this is where it gets lethal for the paper crowd. For years, the West has treated silver as a cheap input and a playground for leverage. The East has treated it as a strategic material. While New York traded contracts in circles, Asia quietly pulled atoms out of the pool. If Asia opens tonight and simply shrugs at 79 and says, "Fine, we'll pay 82, send it," the entire price discovery mechanism shifts another step away from the COMEX screen and towards real-world bids for real-world metal. That's the tectonic subduction the banks are really afraid of. The old paper plate, Western futures exchanges, London unallocated pools, is trying to ride on top of a deeper plate of physical flows moving east. When those plates slip, you do not get a gentle trend. You get a sudden lurch. Bridges crack. Old maps stop working. This is why you're hearing new phrases in those rooms today like market integrity, temporary measures, and disorderly conditions. Those are polite codes for we might have to break the rules to save ourselves. They will frame it as protecting you, circuit breakers, position limits, maybe even temporary restrictions on taking delivery, all in the name of stability. But you and I both know the truth. When a casino is short chips and the high rollers are demanding cash out, the last thing the house wants is for the public to realize there's not enough money in the vault. So what does this mean for you, the prepared investor, on this quiet Sunday morning? First, it means stop treating this as a normal dip and rip. We just crossed a line where the system itself is in question. Once silver has printed 79 with a weekend gap and forced emergency meetings, no one in that ecosystem will ever fully trust their models again. Second, it means understanding the difference between owning the story and owning the atoms. If you hold paper claims, ETFs that may or may not be fully backed, unallocated pool accounts, derivatives in levered broker accounts, you are sitting inside the hydraulic system that just seized. Your fate is tied to counterparties who are in those Sunday meetings, fighting for their survival, not yours. If you hold physical metal in your hand, in your safe, under your direct control, you are outside the cylinder. You own the fluid itself, not the promise of fluid. In a world where the pistons are bending, owning the fluid is the only thing that is not a counterparty risk. Third, recognize the disconnect for what it is. The price on the screen is an argument. The atoms in the vault are a verdict. This weekend, the verdict is starting to overrule the argument. The herd will be told that tomorrow and next week that this was an overreaction. And they will be soothed with phrases like profit-taking, technical resistance, and return to normal levels. Prepared investors know better. Prepared investors look at the fact that they do not have enough metal to meet industrial demand at these prices, that they are holding emergency meetings on a Sunday, and they understand what that really means. The people who laughed at stackers are now praying the stackers do not ask for delivery all at once. No one can tell you what happens at tonight's open. Maybe they manage one more rug pull. Maybe they do not. But the structural damage is done. Once the dam cracks in public, you cannot unsee the spray. Once silver has demonstrated it can move 10% vertically in a supposedly closed market, you cannot unknow that the next move might be 20. So here is your strategic armor. Number 1. Do not measure your conviction in ounces by what happens in the next 48 hours on a rigged screen. Measure it by the cold logic of atoms versus paper. Number 2. Audit your exposure. Anything that depends on somebody else making good on a promise in a crisis is not a hedge. It is a liability dressed up as safety. Number 3. Understand your role. You are not the victim in this script. You are not dumb money. You are one of the few people watching this from outside the blast radius, with enough time to act before the herd even realizes there was an explosion. They are in closed rooms right now, trying to rewrite the script, trying to pretend 79.25 was a glitch, trying to buy themselves one more quarter, one more year, one more bonus cycle. But physics does not negotiate. Hydraulic systems under too much pressure do not heal. Dams with visible cracks do not mean revert. This is mathematical inevitability meeting institutional denial, and you are watching it in real time. Hold the line. Own the atoms, not the promises. Stay on the side of material truth, not screen price theater. Because when the Asian markets open tonight, we are going to find out who actually has silver and who only ever had a story.